Hello, this is a little tutorial on amortization schedule or loan repayment schedules. I'm going to show you how to set one of these things up using Microsoft Excel, and the goal here is to give you control over your loan repayment so you can understand what might happen if you pay off a little bit more every month, or what happens if you make lump sum payments. The goal here, of course, is to pay off the principal of your loan, whatever property that you're buying with it, and to give the bank the least amount possible. So here's a Microsoft Excel spreadsheet with a loan amortization schedule. This is for a principal of $200,000, 15 years, annual rate we're call 3.125%, and we're going to start paying it off next month. And so 15 years times 12 is 180 payments. This is the monthly rate and the payment that we're going to make every month, and I'll show you how to get those numbers in just a second. I think first off, it's probably more important just to show you kind of what the whole thing looks like when you're done, and then we'll show you how to build it on your own. So this payment of $13.93 every month has got two components. One is the interest and one's the principal. And only the principal is subtracted from the beginning balance. So let's see, start with $200,000. You pay this much. A lot of it goes to interest, some goes to principal, and then the principal is, $200,000 minus whatever you paid there, and that just cycles on and on. So then the next month, your starting balance is what you ended with the previous month, and then again you're paying interest and principal. And what you see is that as you go through the life of the loan, the interest that you pay shrinks a little bit every month, and it goes down, down, down to almost, and finally bottoms out to nothing when your loan is paid 15 years down the line. And since we're at the end of the loan, we'll take a look here. So most of that payment, $13.93, most of that is actually principal, and that principal starts out kind of low and then goes up as you go. So basically, you're paying them the same amount of money every month, but the bank is making their money up front, and you're not getting much equity in your house or whatever you're buying up front, and that comes later. And so your goal is, if you can pay this off a little bit sooner than the 15 years or whatever your payment term is, then that is so many months that you're not paying the bank all this interest. So just for perspective, what we'll do is we'll just select all of the interest here that we're going to pay. And if you're not familiar with this part of Microsoft Excel, there's a little selection here that can tell you, gives you information about what you selected. And so we're going to click sum, and the sum of all these interest payments is $50,779. Call it $51,000. So I got this loan for $20,000, and I am giving the bank $51K for that loan. And it's business, it's fair, but again, if you can minimize that number, all the better. Okay, so I'm going to go ahead and blank out all these sections here, just erase what's there, and I'll show you how to develop this schedule on your own. And so hopefully this is pretty useful and empowering. So take a look at this, how it's set up here. I think it's worthwhile just to have this organized this manner. Have your principal, years, annual rate, start date, and this is just good for your own record keeping too. And then the number of payments is you're gonna type in the formula equals 12 for 12 months a year, asterisks for times, and then 15 years, and so that's the number of payments you're gonna make. The monthly rate is gonna be your annual rate, so you're gonna go equals, and this is your annual rate, 3.125%. Slash, like you're making a fraction, over 12, and that's going to be this little tiny number. And then here's the meat of the formula. You use the PMT formula. So you're going to go type equals PMT, which is payment, and then open bracket. So actually, you can stop this video and slow it down and kind of take notes here. This is where the business is, right up there. And so you're going to see we're going to type in the rate, and then a comma, and then the number of periods that we're paying, comma, and then present value, and then a comma, and then we're going to type a 0 in. There's some other functions that don't do that much. Okay, so first thing is the monthly rate. We're going to click that and type in a comma, and then we're going to click that box that has number 180. We're going to click that, and then we're going to put a minus sign, minus, and then we're going to click the principal of the present value, and then comma, 0, close brackets. I'm just going to hold that for a second so you can see that formula. And then you can click back on this box too. If you just double click it, again, it'll show you the formula and then also the various boxes that give rise to that formula. Okay, so now we're going to set up our amortization schedule. And so what we'll do is we'll type a couple months, like month 1, 2, 3, and then we're going to, first one's going to be 1, 20, 22, next one's 2, 20, 22. Don't worry, we're not going to type this for 180 times, but basically if you give kind of Microsoft Excel the general vibe of the kind of sequence you're trying to develop, then you just highlight like usually 3 figures of that and drag it on down to about box 180 or thereabouts, and basically that's kind of starts counting all the way up and adds months all the way up to, it's a little scary. The last payment is going to be 12, 20, 19, 20, sorry, 2036. Okay, so here are my months by number, here are the dates, and then beginning balance, we're going to start out with equals that to 200,000, and payment, we're going to do equals, and then click this box there. That's going to be the payment, and then the interest is going to be equals the interest rate times the beginning balance, and that's how, so 1393 is going to be my payment. This is my interest, and so there's some principal left over, so the principal is going to be equals my payment minus what I paid in interest, and that's my principal, and the ending balance is going to equal the beginning balance minus not my payment but the principal. So this kind of gets depressing because this number doesn't change that much. Okay, so now we're going to basically copy all these functions down and just drag them throughout the sheet. But a couple things we have to do is, if you are, for the principal, it's pretty easy to drag that one down because basically it's saying look at what's 2 spots to your left, subtract what's 1 spot to my left and give you that number. When we're basically calculating the interest though, we're telling it pick this number here, multiply that times something that's 5 numbers up and 1 to my left. And so as we drag that down, it's going to basically sort of pick sort of weird squares to make the formula. And so because we want it to go back to this, to that square every time, the D2, what we're going to do is we're going to put dollar signs in front of D in 2, and that'll take care of that. And then for the payment, because the payment's going to be, so if here I'll show you, if I drag this down, basically what this looks like, it's D3, but basically what Excel is doing is it's saying go up 4 squares and tell me what's there. And so when I copy that function down here, it picks up what's on that square, and this line will pick up what's on that square. So again, that doesn't work very well. And so what you have to do is say, okay, I want it to be D3 all times, not just what's 5 lines above me. And so if you do that, you can see, gee, that's a lot cleaner. Okay, and then finally, the beginning balance for a given month is going to be the same thing as the ending balance of the prior month. So now we are pretty set up. What I'm going to do is just drag these down 1. And so this whole series of lines has all the functions that we need. So we will highlight those and just drag them down to month 180, and just kind of double checking this is what we saw before. We saw by the time the loan's paid off, the interest is kind of whittled down to nothing, and the principal has gone up and up and up. So this is the exact same amortization schedule your bank will give you when you get any loan. There's no shortcuts, there's no nothing. This is just all the standard formula. This is totally identical to what the bank will give you. So now you can look at a couple different repayment scenarios. So let's say you hit the jackpot and get $100,000, and you ask yourself, okay, well, what if I put $50,000 into my home loan or boat loan or whatever this is? What will my loan payment scheme look like then? Well, again, when we summed up all the interest for the loan as it's set up, we came up with $51,000 that we will pay for interest. So let's say we're starting out here at $200,000, and the question is, what happens if we pay down $50,000? So that means we're going to come down to the line where the beginning balance is $150. So 150 is like 200 minus 50. So by mailing a check for $50,000, what that has done is it's kind of fast forward you down to this line here where the beginning balance is $150,000. Basically, you've gone from 2022 to 2026. So you've gone in a time travel machine financially for 4 years. You're 4 years ahead of schedule. And the payment's going to be the same, but let's take a look at this. Let's just sum up all the interest that is going to be paid. And wow, the sum is $26,000, not $51,000, but $26,000. So you've saved yourself pretty close to $24,000 or $25,000 by just paying off your loan, like paying the principal that you owe anyway. But that extra money, that extra fluff that the bank is making off of you is going away. And so that loan's been paid off. Also, you came in at, I forget what line it was, but basically you've kind of zoomed ahead 4 years, and so your loan will only be 11 years now instead of 15. So let's see what happens. Let's say you decide you can afford actually $1,500 a month instead of $1,393. So we're going to type in $1,500 for the payment, and then basically that whole payment is now, that whole column is now turned into $1,500, and all the calculations of interest, principal, and ending balance are now based on that new payment. And so again, let's just say you're starting out anew, just paying that little bit more per month. What you see is, like, again, looks like about 1.5 years ahead of schedule you've finished paying your loan off. So you've gone 164 months, not 180, into paying it. So you get your house or boat or whatever a little bit ahead of schedule. And then also the sum of all your money that you're paying to the bank, instead of $51,000, is $45,900, call it $46,000. So so now you might be paying $46,000. Again, you save $5,000 just by paying an extra $150 per month, and that $150 is paying off your house, your property. That's not money to the bank. You are paying less money to the bank. So anyway, this gives you an idea about how to set this thing up. If you do it right, it will come out right. You can double check it with maybe some online calculators, but this gives you a tool that you can use in your home to plug in things like, what if I get a lower interest rate? Boom, everything automatically recalculates. What if I pay, something, you have, something lower than, you have something higher than what you normally pay, calculates that out. So you want to pay not 200, you got to pay the minimum amount, sorry. So let's say you're paying $2,000 a month. Again, you can go ahead and just sort of like sum all the interest and see how much money you're paying, more or less, etc. So believe it or not, when you go to the banks and ask them basic questions like, hey, if I paid $5,000 off my home loan, just like cash lump payment right now, how would that change things? Or if I was pay more a month, how would that change things? They'll never give you a straight answer. They will try to sell you something else. They'll try to say, oh, well, gee, what's your credit score? Wow, you know that you qualify for this other loan program? They will always try to sell you something, but they will never try to help you understand how you can pay them less. So this is why you need to do this on your own, and this is totally above the board. This will work. This has worked. This is working, and this is something that you should just be aware of.